Welcome to the PJ Finance Show.
Today we will discuss a framework for country investment Part 1.
Hey Joe, long time no see. Where have you been?
Why do you ask? Any suspicious looking people looking for me?
No, should there be? Are you in trouble?
Just kidding around. I had a great break. I flew to LA to spend the whole holiday with my friends, and they taught me how to surf. How was your break?
Oh, I stayed in New York, and did some research.
Sounds boring, but I am in a good mood. Tell me more about your research.
But let me ask you, how do you create a framework to analyze a country's investment possibilities?
Easy peasy. But you need to build a strong foundation first. You need to read the financial newspapers and actively take notes on the articles you read.
What kind of information do I need to keep in mind?
Look at how the articles relate to different assets, economic data, and macroeconomic policies.
This does not sound easy peasy to me. Looks like a lot of work. How does this then help me to decide when we buy or sell?
Although it is a simple question, we must explore the reasons behind it. You'll need a process, a plan, and know the investment jargon. Same thing here. If you're thinking about purchasing a smartphone, you should consider the device's specs and compare them from brand to brand. We all know that these countries have different currencies, thus in order to make the pie chart, we must convert all of them to US dollars.
Looking at this chart, I believe the United States has the largest economy.
Well, it all depends on the market value, which is the exchange rate on a particular day.
If the yen were to strengthen sharply, the Japanese economy would look a lot larger in this pie chart. Is there a way to compare these countries without relying on the market exchange rate, which fluctuates a lot?
One common way is to use the PPP, purchasing power parity.
The purchasing power parity, PPP, exchange rate, the rate at which the currency of one country would have to be converted into that of another country to buy the same amount of goods and services in each country. To understand PPP, let's take a commonly used example, the price of a hamburger. If a hamburger is selling in London for £2 and in New York for $4, this would imply a PPP exchange rate of £1 to $2. This PPP exchange rate may well be different from that prevailing in financial markets, so that the actual dollar cost of a hamburger in London may be either more or less than the $4 it sells for in New York.
This type of cross-country comparison is the basis for the well-known Big Mac Index, which is published by The Economist magazine and calculates PPP exchange rates based on the McDonald's burger that sells in nearly identical form in many countries around the world.
Many people would not consider India and Indonesia among the top 10 countries to invest in based on the previous GDP chart, but PPP says otherwise. I will need to pay close attention to these countries since their future impact on the world is certain to be significant.
Yes, as a result, the market impact and expected rate of return investing in these countries will correspondingly increase.
On the other hand, perhaps I should just focus on investing in rich countries.
Sure. You could do that, and I would look at per capita GDP based on purchasing power parity.
When the growth rate of a country with a big population is divided among all citizens, the per capita GDP drops significantly. When it comes to countries with lower populations, it suggests the opposite.
And?
This implies that when we sell products or evaluate a company's sales, we have to consider the affordability of an average person in that country. But how do I take into account selling to a country with a rapid growth rate? Faster growth rate is better, right?
This table shows India's rapid growth. However, a closer look reveals that the base, in other words the size of the GDP, is far smaller compared to other countries with lower growth rates.
Now I see it. Despite a growth rate of only 2.9%, the United States' year-on-year increase in spending is 3 times higher than India's.
Exactly, and China's expected annual increase in spending is $900 billion, compared to $600 billion in the United States and $185 billion in India. As a result, it's difficult to avoid doing business with China. Regardless of the fact that China's real GDP growth rate has plummeted, the year-on-year change is much higher, at roughly 1.3 trillion RMB compared to 1.0 trillion RMB in 2012. To conclude, a larger economy requires less annual growth to increase overall spending and income.
I see. Thanks to you, Joe, I now have a better understanding of it. But why are we in the park now? We were meant to be in the office, right?
Wait. I didn't realize that we were talking and walking and have left during office hours. Let's hurry back before we're fired.
Typical Joe. I'm blaming you for this.
But I made it clearer for you.
Thank you for watching. This presentation on a framework for country investment is brought to you by the PJ Finance Show.